The Olympic gold medal for the story of this week undeniably has to go to AMC and all the other meme stocks that have really dominated the storyline, whether you talk about GameStop, BlackBerry, Bed Bath & Beyond, and a few others. But really, wherever you looked this week, whether it's CNBC and the analyst community, social media, other financial press, it's all about the meme stocks, those cult stocks that are highly volatile, momentum, price-driven stories that one day go up 60, 70, 80, 90% and the next day down 30%. But I have yet to see a story or a source really that would discuss a little bit more in depth how to be successful trading these markets, which are extremely volatile, very risky, and not for everybody. But a few people actually talk about the rules that people should follow. So today I want to go over 3 basic strategies that should help you navigate these markets more successfully, and then spend a few minutes on the actual AMC business, because it is an interesting business. I'm a huge fan of AMC Entertainment. I obviously love the movie business, but there are fundamentals behind it that sometimes are not necessarily spoken about in too much detail in all of these media outlets. All right, let's do it. All right off the bat, I want to dispel a myth that's kind of out there, and that's the talk of diamond hands, of holding the line, never selling, just buy and hold. That's really not the case when you look at the numbers, because in the case of AMC, for example, AMC has 512 million shares outstanding. That's how many shares are available to be traded, 512 million. And yet this week we traded 3.5 billion AMC shares. So 6 times the volume that's out there, that's available to be traded. So people trade in and out of these positions. And there's a huge turnover, right? So the whole diamond hands will never sell, will create a short squeeze. That's not necessarily true. So effectively, you're playing a game of musical chairs. You're half of the game of being successful trading these highly volatile momentum price-driven shares is understanding how to get out and when to get out before everybody else sells. So that sets me up for my 3 rules. Rule number 1, you have to define your exposure. You have to understand how much capital you're willing to risk here. Even if maybe this is money you're willing to lose, you don't necessarily need, it's entertainment. You want to be able to play the second time and the third time if you get it wrong the first time, right? So whether it's 2% of your capital, 5%, 10 or 20% of your capital, you got to understand how much money you're willing to lose on that position when you're defining your exposure. And if you do this successfully, let's say you invest 5% of your capital in a meme stock and that stock really takes off, and suddenly that 5% becomes 25% of your capital, right? Because that becomes so much more valuable. Then you just resize the portfolio. You take profits on these and suddenly you're playing with the house money. So that's how you successfully avoid being burned, right? Because if you invest all your capital the first time and you get it right, okay, so let's say you double your money, then you invest all your capital again and you get it wrong, you're 60% down. So you can have this yo-yo in your portfolio, in your capital allocation. So defining your exposure is rule number 1. Rule number 2 is defining your exit point. You have to understand how you're going to exit your position. Whether it's if you make money or if you lose money, you need to have a take profit and a stop loss in mind that's firm, that you don't keep moving. Simply because so many people have giant paper profits and they become too greedy, they suddenly want a few more percent. What if it goes a little bit higher? I don't want to have any regrets. And those paper profits then whittle down to nothing and then they start losing money, and obviously they make the same error on the downside, never kind of selling. So you have to be firm and be able to define an exit point on whatever allocation you made to a meme stock, whether it's AMC, GameStop, or whatever else it is. You have to understand and be very, very firm on how you exit that investment. And rule number 3 is you should be using options here, because options give you 3 advantages. The first advantage is it defines very clearly how much you're willing to lose, because the premium you pay for the option is exactly the amount that is the maximum amount you're going to lose on the position. So you're not losing sleep, right? You're not investing in a stock and waking up fearing whether the market's going to open, whether you're going to be 20 or 30% down, or whether you're going to be up. With an option, you buy an option and you know exactly how much money you wasted potentially if you're wrong. The second advantage of options is leverage. You can have a much larger position for a defined amount of capital simply by buying cheap options, right? So leverage is a huge advantage when it comes to trading options. And 3, and this is a great advantage when it comes to these highly volatile momentum-driven stocks, and that's volatility. So as you know, options are priced based on the time to expiration, the relation of the price versus the strike, but also volatility. Volatility is a huge component when it comes to options pricing. And so when you have a move like we had in AMC, when you have a 90% up move in one day, well, believe me, that volatility is super high. And for example, on Thursday, the options expiring the next day on Friday, they trade at 1,000% volatility. So in an extreme case, let's say let's say the stock price for whatever reason would not move, but volatility goes up, your option becomes more valuable. So you want to use this volatility, the huge swings in volatility to your advantage, because they help make these options more valuable. Let's talk about AMC for a second, because really this was the story of the week, and I think in the long run fundamentals are going to matter. And so it's important to contrast where the company really stands now and what they have looking at for the next 6-12 months versus what the valuation has done and this huge momentum that the stock caught. So first of all, I want to congratulate the CEO. I think he's done a phenomenal job. He deserves a lot of credit for saving the company. Back in December, January, AMC was very close to running out of cash, and they managed to raise capital. Then they caught some momentum in January alongside GameStop, and the stock started pushing higher. And then a few more capital raises over the last several months, right? This week we had two of them. We had Modri Capital buying $230 million worth of shares, then flipping them the next day, which is, by the way, very unusual. There's normally a restriction clause for how long you have to hold the shares. But Modri Capital made $75 million on this very quick trade on AMC. And then on Thursday, we had the latest capital raise for close to $600 million, which came alongside an announcement from the CEO warning his investors that they might potentially lose all of their capital, which, by the way, is very unusual as well. This was on social media. He tweeted this out to his investor base, but also this was on the filing with the SEC. So looking at, this is on the positive side, but looking at the AMC business, what that business has done over the last several years and where it stands now. If you look back at 2016, this was the latest high in the share price that, kept drifting lower and lower. And even before the pandemic started in 2019, AMC was generating about $5.5 billion worth of revenue, but losing $100 million in net income. So this was a losing proposition even before the pandemic. And the pandemic changed a lot when it comes to the movie entertainment business, because think about how you consume media these days. Think about what happened to companies like Roku, HBO, obviously Netflix is still here, Hulu. The whole movie entertainment industry now is releasing movies simultaneously on both platforms, right? To the movie theaters and onto the streaming services, because this has become a huge part of the business, because the movie studios are now getting paid a huge amount of money from Netflix and others. So this is a business that, AMC now clearly they raised more than $1 billion worth of equity, and they will be able to consolidate their position in the market, pick up a few movie theaters, maybe some other chains, and dominate kind of the market because they have the capital to do so. But this is a total addressable market that is shrinking and was shrinking over the last several years. So this is not a high growth, cash generating business. This is a business that really is on the decline ultimately. And so when you look at the valuations here, right now AMC is valued at 66 times EV/EBITDA, where Disney, which has a much better balance sheet, a growing business, streaming business, but also obviously a real physical business, they are at a 22 multiple. So 66 versus 22 for Disney. When you look at the financial situation, AMC still has $5 billion in debt, right? So they'll be able to use some of that money they raised over the last few months to pay off some of that debt and consolidate that. But they have that money due later this year and 2022. So they're going to have to really use a lot of the capital to kind of shore up the finances there. And finally, if you say that, well, I'm investing in AMC because I believe in this business, I think this will come back after the pandemic. We'll all go back to the theaters and this business is going to generate money. Well, then are you investing in all the other ones like IMAX and Cinemark? Because when you look at Cinemark, for example, Cinemark before the pandemic was valued just about the same. This was a very similar business to AMC, right? About $5 billion in terms of market cap. Today, Cinemark is $2.5 billion worth of market cap. And that business really hasn't changed to what AMC is. I think these are very comparable businesses. So you have Cinemark valued at $2.5 billion in terms of market cap versus AMC, which now is at $30 billion. So again, I'm putting all these facts out there just to kind of underline the fact that what we have seen over the last several weeks, and this may last a few more weeks, obviously, was a momentum-driven price event in AMC. This is not fundamentally justified when you look at the financials of the company. The CEO himself is saying that. The investors themselves are saying that. But if you're investing in AMC for the fundamentals, they are probably better investments. So again, that leads me back to the subject of this video. You know, there's going to be other meme stocks, other stocks that will catch fire over the next few months. Retail investors are here to stay. They want to stick it up to the hedge funds. They will pick up other stocks. And if you follow those 3 simple rules and have a strategy on how much money you invest, what your exit point is, and be smart about using options to your advantage, there's really smart ways to keep making money in these markets. So much for a quick chat today on all these meme stocks, AMC, and how to profitably survive these volatile markets. Anyway, I kind of feel like let's go to the movies. Let's go to AMC, watch a movie, go to GameStop, buy a game, tweet out about it on a BlackBerry. Does BlackBerry have Twitter? I mean, I don't know anybody who has BlackBerry, but we could try. And then maybe go to Bed Bath & Beyond, buy a pillow to end the evening. I mean, if you're going to be buying these stocks, you might as well support all these businesses. Why not? Anyway, thanks for hanging out, guys. Make sure you give a like to the video, subscribe to the channel if you haven't yet, and I'll see you in a few days.